In this session, we will be talking about the Wiener process as well as the Ito's lemma, which are one of the or some of the key aspects that go into the pricing of the options and that play an important role in the derivation of the Black-Scholes formula as well. Black-Scholes option pricing formula. So just trying to understand the conceptual aspects behind this derivation. Though we are not deriving this, we really need to understand what all applications can use this Wiener process. What do we mean by Wiener process? And how the solution for those kind of differential equations is coming into picture. So there is a lot of usage of differential equations, and probably there is some understanding of the calculus which is very much required as a part of this chapter. So in this context, a few things which we are going to cover. What is meant by the Markovian property? Right? Does the stock prices follow the Markovian property? First of all, what do we mean by that? Then, what are stochastic processes and the differentiation between the continuous time and the discrete time? How do I define the process for stock price? How do I get into the finding of the parameters? If at all the processes are more and more correlated, what should I do? With all this as a base, we will introduce Ito's lemma, which is the base for the derivation of the Black-Scholes option price formula. And towards the end, we will introduce the log normal property of the stock prices. Okay, so before we talk about the Markov process, first of all, let's understand the definition of a stochastic process. Any variable, so probably let's say the stock price, let me call the variable as the stock price. Any variable whose value changes over time. So today's price, tomorrow's price changes in an uncertain way. I don't even know what would be the change. That is what we call as a stochastic process. Now, there are four major dimensions or four major types of stochastic processes. I can look at two on the time dimension and two on the state dimension. So it is more like, probably let me form a box like this, right? Like if I say this is the time dimension and this is the state dimension, it is like this: continuous state, discrete state, continuous time, discrete time. So I can have four different kinds of processes: continuous state, continuous time, discrete state, continuous state, discrete time, something like this. Now, first of all, understanding what these are. When I say discrete time stochastic process, the value of the variable, whichever, let's say stock price. If I'm saying the variable is stock price, the value changes only at certain fixed points. It changes, let's say, only at the end of the day. So, for example, the NAV for a mutual fund, it is changing only at the end of the day. And I don't know in what way it is going to change. So, wherever the price changes only at certain fixed points in time, we call them as discrete time stochastic processes. But if the value can change at any point in time, that is where we call them as continuous time stochastic process. So probably the stock price can literally change any time during the market hours, right? So that could be more and more continuous. Similarly, when you are talking of state variable, if it can take almost any value, probably in a particular range, it can take to any decimal, any precision, any value. Then we call it as a continuous. But if it can take only a specific set of values, we call it as the discrete variable process. In practice, or probably for all the modeling purposes, the stock prices, we take them as continuous time, continuous state, or continuous variable kind of process, which means almost any value can come up and almost at any point in time the changes can happen. But of course, we know the reality. The reality is probably the changes happen only during market hours. After the market hours, the prices don't change. And along with that, even the values wise, probably to the nearest cent, the changes could be in terms of cents, but it can't be a microcent or $0.0001. So those kind of values are not possible, but still more and more closer to practicality, we say that we try to consider even the stock price changes follow a continuous time, continuous variable stochastic processes. Now that we got a basic understanding of the four different types of stochastic processes by taking time and state as the dimensions, now let's understand what a Markov process is. Now, if I have to do a prediction of the price for tomorrow, right? Predict the price for tomorrow. What the Markov property says is only the current value of the variable will be relevant. If I am able to predict the price of tomorrow by taking only today's value, the current value of the price, and not the historical. I don't take yesterday's, day before yesterday's kind of values. Only the current value is sufficient to predict the future. The past history and how it really came, was it in an increasing trend, was it in a decreasing trend, if they are becoming really irrelevant for predicting the future, those kind of processes is what we call as Markov process. So if I have to predict the stock price, if I am just taking the current price as a base, not the past prices and the way the past prices have emerged, then we are calling those kind of processes having Markov property. And for all modeling purposes, the stock prices are generally assumed to follow a Markov process. So, what is the interpretation now? If I have to really predict the future, means if I have to create some kind of probability distribution of the prices for the future, I am not at all considering the path the price has followed in the past. Which means probably this is where I try to link it with the market efficiency or efficient market hypothesis, which clearly states in that there are three forms, one being the weak form efficiency, which clearly states that the price of a particular security incorporates all the historical information about that particular security. Then the market is weak form efficient. Otherwise, the technical analysts are going to do a lot of study with the graphs, charts, interpretations, and they would be able to predict the future price just by looking at the past history of the stock prices. So that makes the market more and more inefficient. Which means what this Markov process, if I'm saying stock prices follow Markov property, the weak form efficiency is very much existing in the market. But the path that the stock has followed in the past will not in any way influence the prediction for the future. The present price of the stock contains all the information that is the record of the past prices. So Markov property is very much inconsistent with the weak form efficiency of the market. So technical analysts will not be able to make abnormal positive returns, abnormal above average returns by just interpreting the charts and the past history of the stock prices. And how does the price follow the Markov property? Majorly because of competition. New players enter, existing players move out, new investments come in, existing investments are pulled out, demand supply changes because of the competition, and the prices are going up and down. So for now we can very comfortably assume that the stock prices follow a Markov property, which means if I have to predict the stock price for the future, I will rely only on the current price and the past price, as well as the path that the price has followed in the past will not have any kind of influence for the future. That is what is the Markov property all about. Now, let's talk about the continuous time stochastic process. Now let me think about a variable that is following a Markov property and is a stochastic process. So let's talk about the stock price itself. Let's assume that the stock price follows a Markov property and it's a stochastic process because it changes value in an uncertain way over time. So just as an example, I am saying let the current value is 10 and the change in its value during the year. During 1 year, let's say it is changing in this manner. Phi is a representation of normal distribution. So the change, let's say, is normally distributed with a mean 0 and a variance 1, which is otherwise saying the change in the value is following a standard normal distribution. Right? I assume that the current value is something and the change year over year, change during a particular year is following a standard normal distribution, mean 0 and year 1. A few interesting things which we talk about is if it follows a Markov property, right? Even if I am taking a 2-year period, year 1, year 2. Year 1 follows a standard normal distribution. Year 2 also follows a standard normal distribution. Now, this is the change in year 1, this is a change in year 2. Now, if I want to talk about the change in 2 years, I can simply add up the means, I can simply add up the variances. So, for a normal distribution, if you remember one of the properties of the normal distribution, the linear combination of 2 or more random variables is still a random, 2 or more normally distributed random variables is always a normally distributed with a mean mu1 plus mu2 and a variance sigma 1 squared plus sigma 2 squared. The same logic if I am putting here, if they are two independent ones, yes, they are independent because they are following Markov property. So one value is not based on the past values, so they are independent. So that is where I am saying for a 2-year period, if I am looking at the change, it follows a normal distribution with a mean 2 and a mean 0 and a variance 2. Mean is the sum of means, variance is the sum of variances, resulting in a normally distributed random variable with a mean of 0 and a variance of 2. Which means, if at all, during a year period, during 1 year, if it is following a standard normal distribution, right? If a particular price is following, value is following a standard normal distribution in 1 year, then In 2-year period, it will follow a normal distribution with a mean of 0 and a variance of 2. In a T period, it will follow a normal distribution with a mean 0 and a period and a variance equal to T. Variance of the changes in successive periods is additive but not the standard deviation. Here the standard deviation is becoming square root of 2 and not 2. So this is one base for a lot of study that we are going to do. If at all we are able to create a value which follows a standard normal distribution during a year, then we talk about over successive periods or over T periods, it follows a normal distribution with a mean 0 and the variance equal to T. Now, this is when I want to introduce you to this Wiener process, where we have already talked about a Markov stochastic process, which is having a standard normal distribution. The change is following a standard normal distribution, means with a mean of 0 and a variance of 1, just like the earlier example that I have mentioned. Any process where the change, any variable where the change follows a standard normal distribution, that kind of, and a Markov property as well, that kind of a process we call as Wiener process. And in other terms, it's also called as a standard Brownian motion as well, right? Because it's also called with the name of Brownian motion, where the mean change is 0 and 1. In general, the Brownian motion is normally distributed with some mean and some variance, but the moment I say standard Brownian motion, it is as good as with a mean. The change is happening in the variable over a period, over a year period, with a mean of 0 and a variance of 1. That is where we call it as variance rate of 1 per year. So here we bring in the time angle into our analysis. Now, if at all I have to talk about a variable, so here whenever we are talking about variable, let's talk about the stock price. If at all I have to talk about a variable following a Wiener process, there are two important properties that needs to be satisfied. So whenever I am talking about a small change z during a small time period delta t, it is nothing but, I'll take it as the change in z is epsilon times square root of delta t. This epsilon is nothing but a standard normal distribution, a value that is coming from a standard normal distribution. So the epsilon is a value that is coming from a standard normal distribution. Delta t is the time period. So we say the value of delta z, which is the change in the value of z, is nothing but the standard normal variable times square root of delta t. So this is one important property of Wiener process. And for any two different time periods I take, delta t1 and delta t2, whatever the delta z's that I am getting, they are independent. Because they follow a Markovian property, they are independent. So within a very short interval, we are talking of these two being the properties that are being followed. Now let's take it slightly further, saying I want to look at it for longer period of time. So longer period is nothing but many such shorter periods. So delta t1, delta t2, delta 3, all these put together is probably a long period t. Now here all you are finding that the mean in all these cases, what is the mean for each of these periods? Each of them follow, each of them are following a normal distribution. So probably it is coming out that they are all phi and delta t. So it is very much, each one is following phi and delta t, or delta t1, delta t2, delta t3. Now if I have to add all of them, because I want it for a t period of t, it follows that it follows a normal distribution with a mean 0, delta t1, delta t2, delta t3, which becomes my almost t. So the variance of the change right from the t period to the 0th period is t. Mean of the change from the tth period to the 0th period is 0. So the standard deviation is square root of t. And whenever we are talking of these, okay, here till now we are talking of delta z. Now we are introducing another term called dz, which is more like if delta t, which is the time period, is almost tending to 0, we say whatever is the value of the delta z, we actually call it as dz using the concepts of limits and derivatives. Right? If you remember the concept of derivative, if I have to talk about f dash of x, we used to say f of x plus h minus f of x by h as h tends to 0. Now the same logic we are trying, whatever is the change between the final value and the original value, as h is becoming closer and closer to 0, whatever is the delta z, as delta t becomes closer and closer to 0, we call it as dz. And that dz we say is the Wiener process, means it is having all the properties of delta z only when the delta t is becoming closer and closer to 0. So a few important points regarding the Wiener process from this particular slide, right? Any process which is having a mean of 0 and variance rate of 1 per year is said to follow a Wiener process, otherwise called as a standard Brownian motion. And if something is following a Wiener process and I want to do the prediction for time periods, longer time periods, the mean of that change is still 0. The variance of that change is equal to the time period which we are using, and the standard deviation is the square root of that time period, right? Now we will try to generalize that Wiener process, because in the Wiener process that we considered in the earlier slide, we said a mean of mu and variance rate of 1 per year. Now when I'm trying to generalize it, I'm actually trying to change the mean by something else, the variance rate of something else, right? So that is where I'm introducing two important terms. One is the drift rate, which is the mean change per unit time for a stochastic process, right? It's not 0 now. In case of a basic Wiener process, standard Wiener process, standard Brownian motion, the mean is 0. But here, if it is non-zero, we are saying that it is a drift, a mean change per unit time for a stochastic process. So when I'm saying 0, if the drift rate is 0, it means that the expected value at a future date is always same as the current, because there is no change in the value. Change is having a mean of 0. So the expected value at a future time is always equal to the current value itself. And when I'm using the word variance rate, it is like variance per unit time. Again, if that value is 1, then it means that when I'm talking of t periods, t years or t periods, the variance will be equal to t itself. But now when I'm doing this generalized Wiener process, I'm trying to bring in a non-zero mean and a non-unit variance. So if you look at it, if I am assuming a small time period of dt, for each time period there is a drift of a. For each time period dt there is a drift of a, and b times dz. Dz is your Wiener process. Dz is that Wiener process which is following a normal distribution, standard normal distribution. Now I am putting a b times to it, which means here the variance rate is b. Now look at it. So if I am talking about a dt, it is the x is changing in such a way that it is changing at the rate of a per unit of time. Right? For every unit, it is changing at the rate of a, and in dt time period, it is changing by a dt. Now, if this term is not there, right? If b dz term is not there, so what does it mean? In a small time period, it is a dt. So it is as good as, now what is the new value of x? The new x, which is x1, is nothing but x naught plus whatever is the change that has come out here. So in, let's say, in a time period t, if I am really looking at it, I am getting it as x naught plus at, because in time period t, if I am looking at, the change is to the extent of at, and what we are saying is x1 will become x naught plus at. So the variable is increasing in a time period t, the variable is increasing by an amount of at. But when I am introducing the b dz term, it is more and more of, okay, it becomes x plus at, fine. But something more than this, something less than this is possible because of the stochastic nature, and that b dz term is adding the variability to the path. And we are seeing that it is b times the Wiener process. Those kind of processes, if something is following of this type, right, a times dt means there is a drift rate of a, and b times dz, which is the variance rate, is not 1 here. The variance rate is going at the rate of b square. Now in a small change of time, in a delta t, we are looking at the change delta x. So either I call it dx, or in discrete time we use the word delta x. In continuous, probably we call it dx. In discrete time we'll call it as delta x. So again here also we can see a times delta t plus b epsilon. We know that z at any point in time, in the previous slide if you see, z at any, delta z at any point in time, we said that it will be epsilon times square root of delta t. The same logic I am bringing here, b times dz. So b times delta z, and delta z we know that it is epsilon times square root of delta t. So in a small interval delta t, if I want to know what is the change in delta x, I can very well go with this. This is a standard normal distribution with a mean of 0 and variance of 1. So for this kind of a process, if I am looking at a time interval t, then obvious, the mean during this period, the mean change is at. The variance of b dz, which is nothing but b squared times the variance of dz, and variance of dz we know that it is for one period it is 1, so for t period it is t, so it becomes b squared t, and the standard deviation of the change in x is going to be the square root of the variance, which is b into square root of t. So this is the generalized Wiener process, which will follow the form of dx equal to a dt plus b dz. Now an improvement on that generalized Wiener process, right, where we said a dt plus b dz. Now the interesting part is, if a and b are constants, it's a generalized Wiener process, right? If a and b are the functions of the underlying variable x and time t, Means instead of A, if I am writing as A of x comma t times dt plus B of x comma t times dz. So instead of these being constants, if they are some functions of x and t, that kind of a process is called as Ito process. Right? We are talking of dt, which is a drift rate. Right? We are talking about the drift in a time period t is not a constant, but it follows some kind of function of x and t. Similarly, the variance also follows a similar kind of a function of x and t. Then we call the change in x dx that is coming out is following an Ito process. So, which means both the drift and the variance, both of them are possible for a change over time. So, in a small interval, again in delta t, if I want to see my delta x, again it goes the same way. A times delta t plus b times delta z, and delta z I know it is epsilon times square root of delta t. Now, if at all the drift and the variance are constant, then it is as good as your generalized Wiener process. And it's a Markov process because at any point in time, the change in x and t, it is depending only on the current values of x and the current values of t, but not the historical data. So, Ito process is internally a Markov process. Now, using these three, which means right now we have seen three types of processes. One being a standard Brownian motion process, which is the general Wiener process, the regular Wiener process. Then we have generalized the Wiener process by bringing in a drift rate, a constant drift rate and a constant volatility. And on the top of that, we have brought in an Ito process where we talked about a variable drift rate as well as the variable variance rate, following which is a function of the underlying variable as well as the time period. Now, the next thing which I want to look at is stock price. Does it follow any of these three processes? Right? Does it follow a constant drift and a constant variance? Or does it follow a functional drift and a functional variance? What kind of process the stock price, especially the non-dividend paying stock price, follows? It's a very common way to visualize. A lot of people visualize that it follows a generalized Wiener process, means a constant drift, constant volatility. But it is not following. See, look at like this. Today, if the stock price is 100, right? Let's say the expected, if I'm saying constant drift, at the end of 1 year it becomes 110. At the end of 2 years it becomes 120. At the end of 3 years it should become 130. Now you could see this is resulting in a 10%, but this is resulting, let's say, only in a 9%. And this might be only 8.5%. I'm just taking some numbers, definitely not 10%, less than 10%. But the expectation of the investor always is his expected percentage return is more or less constant, not the absolute change in the value. Right? Even if it's not like even after the stock price goes to 200, he wants only 210 at the end of 1 year. The regular generalized Wiener process is talking about a constant drift. So there is a change to the extent of 10 every year or every time period t. But that is not the expectation of the investor. The percentage return, what he wants, is really independent of the stock price. He wants a constant percentage return, not the absolute change in the value. Right? So I can't use a generalized Wiener process for the moment of the stock price. Right? So the whatever we have assumed that the expected drift rate is constant. The drift rate can't be constant for the stock price. It's only the expected return has to be constant. Means the percentage change, not the dollar change, not the value change. The percentage change should be constant. Right? So if I'm saying S is the stock price at time T, so the expected drift rate is some proportion of S. It can't be S plus mu. It has to be mu S. Right? So this is what is the difference, and that is what is very much expected, which means if I am really looking at modeling the stock price, I need the change in the stock price to be mu S times delta T. I don't want it to be mu delta T, right? If it is a generalized Wiener process, it is that delta S is mu delta T. ds is mu dt. Of course, ignoring the random term, right? bdz, ignoring this, ignoring the variance term. If it had been a simple dz, if it had been a simple generalized Wiener process, I would have got this. But what we are saying now is, because it's not a generalized Wiener and I really want the stock price to be like this, the change in stock is some proportion of the original stock price times delta T. So which means my ds should be mu s times dt. Okay, now that is leading us to something else. If you see ds, I am making it mu s times dt. So take ds by s is mu dt, right? And probably ds by s, if you are looking at trying to integrate, so log s, right? If I am trying to integrate 1 by s ds, so it is becoming log s is mu, and I am integrating this mu over t and 0. So this is mu t is integrated over t and 0. So it is coming out s is s naught into e power mu t. So the differential equation for this, so log s again is integrated between s and 0, s0. So it is becoming log or st and s0. So it is becoming log st minus log s0 is equal to mu t. So it's very much now st by s0 is mu t, st by s0 is e power mu t, st is s0 times e power mu t. Now this is what is the relation. So we don't get something like st is s0 plus mu t. That is what we would have got in a generalized Wiener process. But here we are following what is called as a geometric Brownian motion, which would result in st equal to s naught times e power mu t. Right? And if the variability is present, it's much more appropriate. So I'll say ds is mu s dt plus sigma s dz. Even the variance, even the standard deviation, we are saying the proportionately it is constant. It's not amount wise constant. It's not value wise constant. It's some proportion of the original value itself. So that's the reason even for this we are bringing sigma s dz. So again I can bring ds by s is mu dt plus sigma dz. So ds by s will follow a generalized Wiener process. Right? If you see this, ds by s is following a generalized Wiener process, not the ds. So that is what is the property of the geometric Brownian motion. And in a risk neutral world, we will talk about the risk-free rate itself. So the same thing, if I am expressing it in a discrete, you know it. Now ds by s is following mu dt plus sigma dz. Now I'll take it in a discrete delta S by S mu delta t plus sigma delta dz. Delta dz we have already taken. Delta dz we have already taken as epsilon times square root of delta t. So from here I know delta S is nothing but S times this, which is mu S times delta T sigma S. And we are also seeing now, if you are looking at this delta S by S, it is following something like this, which means it is following a normal distribution. Right now delta S by S is following a normal distribution. What is the mean? Mu delta T is the mean. And what is the variance? I take sigma squared times delta t as the variance out here. So this is the traditional way of looking at the change in the percentage change in the stock price. It is following a normal distribution of this kind. Look at the numerical. Consider a stock that pays no dividend, volatility of 30 per annum, and provides an expected return of 15% per annum. Continuous compounding. Approximate change in S in a week. Right now we say approximate change in S is nothing but delta S. We are talking about mu S delta T, right? 0.5 times, or probably we are asking about an approximate change in S in a week itself. So I can directly find delta S by S. So it is mu times 0.5 times delta T. Now I have to take my T as 1 week. 1 week is 1 by 52 years. So I'll take it as 0.15 times 1 by 52 plus sigma is 30% times the epsilon. Epsilon is a standard normal variable that I have to generate, and square root of 1 by 52. Now this is where I will see that delta S by S will follow a normal distribution with a mean of mu delta T, which is 0.15 by 52, and a variance of sigma squared, which is 0.3 squared delta T is by 52. So this is the normal distribution. So I can very well find out the 95% confidence interval, 99% confidence interval for the approximate change in S in a week's time. So that's the way we can directly bring out the estimation process once I know what is the overall process this particular variable is going to follow. Now, a Monte Carlo simulation is one of the major mechanisms for sampling the random outcomes for the process. It's a way of developing understanding of the nature of the stock prices. Okay, let's see. Let's implement in Excel, right? So let me assume on an yearly basis, right? Probably I'll take the same example. The expected return is 15% per annum, right? 15% per annum, and let's say the standard deviation is around 30% per annum. Now, using this information, I want to generate the possible probability distribution of the prices, let's say after 1 week. Right, I want to generate the possible probability distribution of the prices after 1 week. And let's say today the current stock price S naught is 100. Now we have to first generate, if you look at the process, I say that the delta S by S follows a normal distribution with mu delta T and sigma squared delta T. Okay, so mu delta T, right? So now I have to generate something like this. So first I require this epsilon value. So the epsilon is a standard normal random variable. So first I'll generate some random variable called using a formula called rand, which generates a value between 0 and 1. Which, okay, so I'll generate in a Monte Carlo simulation. What we do is we generate some thousands of such variables. So I'm generating, let's say, around 5,000 such values, right? Let me generate around 5,000 such values. These are all random in nature. So random means they follow a uniform distribution. Now what I do is I convert it into a standard or I convert it into a normal variable or standard normal variable, because epsilon is a standard normal random variable. So what I do, I fix these values, otherwise they keep changing, and I'll do what is called as a norms inverse of this particular value in Excel. Now whatever these values that are coming, they are the entries corresponding to a standard normal variable sigma. Standard normal random variable epsilon. Now I know the mean, I know the S, I know delta T, everything. So let me talk about delta T now. Delta T for me is 1 by 52 because I want to generate for a week. So this is my delta T. Now everything else, or probably I require square root of delta T as well. The square root of delta T will become the square root of this. So this is my square root of delta T. Now I should be able to generate mu s delta s comfortably. So now I am generating delta s, which is mu, which is the mean, times s times delta t. S is the current value. S times delta t, fine, plus sigma times s times, sigma is this one, times s times epsilon times, this is my epsilon now, which is a variable, epsilon times square root of delta t. This is the square root of delta t. Now what comes out is the changes are something like this. This is for delta s. Delta s is the different possible values for delta s after 1 week following this kind of distribution. These are the possible values of delta s at the end of 1 week, which means I know what are the possible values of s for me. For this I will add up my 100 every time. So my delta s, from the delta s I am computing the s, and this is the possible distribution of s for the next 1 week. Now probably if I am simply looking at the minimum value which came out, so there is a chance that s can go up to 84, and if I am looking at the maximum value here, there is some possibility that after a week the price can even go to 117. And now if I really look at the distribution for the same, right, if I start with, let's say, the minimum value with an increment, let's say, of 2 each up to 118, what I will try to do the frequency plot, right? If I try to do the frequency plot for this period, okay, I'll do the computation of the frequency for this period, which gives me that this is the frequency. So if I try plotting a graph for the same, I see that this is the pattern. There are a good number of possibilities. So you see that there is some kind of a normal pattern in which the prices are lying. a good number of values are lying within this interval. A significant portion of them are lying within this interval. And as you are going up and going down, the probability of occurrence is becoming more and more limited. So this is how you are using the Monte Carlo simulation, and probably if I have to say what is the chance that the price will go below, let's say 86 or 87, you say 5 out of 5000. Or even if you say what is the chance that the price can go above 114 or something, you say that it's 4 out of 5000. So the Monte Carlo simulation is helping us to do this kind of understanding. The nature of the stock price process fully we can understand by doing the Monte Carlo simulation, which is using the random numbers and the distributions using the random numbers. The samples per epsilon we are generated and they are independent of each other because it follows a Markov property. And different random samples that we have generated, they have led to different price movements. And that same exercise we repeat. Why just a week? Every day you do it, and daily, based on the daily, you compute it at the end of the week as well. So this is how a Monte Carlo simulation can be used to understand the movement of a particular variable, understand the whole distribution of a particular variable. Now from here, we have to move in terms of understanding the parameters. Okay, we know that mu is the expected return, which is established in annualized terms. And we also know that the higher is the risk that is being taken, higher should be the expected return. So mu is more majorly dependent on the amount of risk that the investor is taking. The higher it is, the more should be the expected return. And at the same time, so mu is very much dependent on the risk level of the stock along with the interest rates in the economy, because higher is the interest rate, higher is the expected return from the stock as well. So mu is dependent on those different values. And when I look at the sigma, which is the volatility, it is very much important in doing the pricing of many derivatives, especially options. And we have already seen that the standard deviation of any change is proportional to the square root of that small time period, square root of delta t. Now comes the next stage. Instead of looking at one variable in isolation, we'll talk about two or more variables, right? Two securities, not just one, but those two are not independent of each other, they are correlated, right? Probably it is like this, some constant a1 and b1 for the process 1, a2 and b2 for the process 2. So the changes are also based on a1 and b1, a2 and b2. But if they are uncorrelated, probably sigma 1 and epsilon 1 and epsilon 2 could be anything, any random variable. I can generate them independently. But if there is some kind of correlation between them, the random samples should come from a bivariate normal distribution itself. Right? The random samples that we are bringing in, they should come from a bivariate normal distribution. Let's do that. What I need to do. Right? Well, when we talk about a bivariate, we will do for two securities now. Just to understand the whole process, let's do it for two securities, the mean and the standard deviations. For the first security, let's say I am taking a mean of 15, and for the second one, let's say I am taking a mean of 20. The standard deviation here I take around 30, here I take around 40. And let's say the correlation between the two, let's say I put it around 0.5. Right? So this is what I really want to get into. Now for this, I want to do the simulation. Okay, the current stock price as 0. For the first one, let's say it's around 100. For the second one, let's say it's around 200. Now, I really want two correlated random variables to be generated. Now, just for the sake, before we do all this process, let me generate two random numbers, two normally distributed random variables, right? So first let me use the rand function. So I'll take two independent sets. Probably let me take around again the same 5000 random variables altogether. Right, I'm taking 5000, or probably now that I got here, let me take around. Okay, now we have got up to here, so let me take around 6000. So 6000 random numbers I have taken, and each one is independent of the other. And I have taken the normal distribution values of both of them. So now the normally distributed value norms inverse of this particular percentage. So I am generating for these two, and I have generated across, right? Now when I have generated this, so it is like, if you look at this, this is random number 1, this is the random number 2, this is the standard normal random number 1, standard normal random number 2. And here let's me try finding out the correlation between both of them. So I'll use the formula correlation between this and this, which is very much close to 0. And probably even if I am looking at the correlation between the standard normal random variable 1 and standard normal random variable 2, it is coming out to this comma this, if I'm taking, it's coming out very close to 0. But I want a correlation of 0.5. Now that is where what we do is we initially start with this process. We take two random numbers, fair enough. Now when I go with the correlated random variable, correlated rand 1 and correlated rand 2, I do a small difference. The first one I keep it as it is. The first one I keep it as it is. That is what we say, epsilon 1 is mu u itself. For epsilon 2 we do this kind of a work. The correlation times u plus square root of 1 minus correlation square times v. So I'll write it as correlation times u. This is my u. Correlation times u plus square root of 1 minus correlation squared times v. V is the second random variable that we have generated. Now look at, right, now these two random variables, whatever we have generated, look at the kind of correlation that exists between them. If I look at the correlation that exists between these two, correlation between this and this, it is coming close to 0.5. So artificially I have generated two random numbers which are having a correlation of close to 0.5 between them. And now when I do the standard normal random variable correlated random number 1, standard normal correlated random number 2, which I am using the norms inverse of these two, right, norms inverse of these two. If I'm going with, this is where I could see, okay, here, alright, so this I have to do, Okay, there are a few pairs which are coming out as now a few pairs which are coming out. This is the random number square root of rho times nu plus 1 minus sigma squared 1 minus. So probably whichever are non-operational, we have to take them out. And after that, we may end up finding out the correlation. But when I'm looking at the correlation between these two random numbers, it is coming out to close to 0.48. And when I'm transferring it to a norms inverse, I have to be slightly careful of, right? I have to be slightly careful of anything that is greater than 1. I may not be interested in looking at it. Anything that is greater than 1, I may not be interested in looking at those combinations. We will directly delete those kind of combinations and we operate only with the remaining ones. And even if we have n number of correlated variables, now we have different epsilons, and which means each one is sampled from an appropriate multivariate normal distribution. So like this we generate and use these numbers now, use these numbers for the generation of delta x1 and delta x2, which is what will generate the new prices for the portfolio. So this is how the Monte Carlo simulation can be used with respect to the correlated processes. And just to understand the Ito's lemma, it is a major thing to compute the price of a derivative, because the price of a derivative, we know that it's a function of the variable, the underlying variable, as well as the type. So we assume that the value of the variable, see, you know that the variable changes over time. Both the drift might change as well as the variance rate might change. So we assume that it follows a standard Ito process. So anything that is following an Ito process, and if we are talking about a function g containing x and t, if I really want to find out the dg, I can directly use this Ito's lemma. I take the partial derivative of g with respect to x, the first derivative and the second derivative. The first derivative I take it with, I multiply it with a. The second derivative, half of it with p squared, and then I take the derivative of g with respect to t. So it becomes all this dt plus dou g by dou x b dz. That is what is the function of g as per the Ito's lemma. So just we'll take one example, right? If I say ds is following something like this, right? ds, if you say, let's try to derive this. If I am saying a process ds is following mu s dt plus sigma s dz, right? Now, so if I am saying this is a of x comma t and b of x comma t is, this is mu s, this is sigma s, right? Now, this is mu s, this is sigma s. dg is, now we have to take it as dou g by dou s times mu s. So here g, let's say I take it as log s. G if I am taking as log s. Now find out dou g by dou s, which is 1 by s. Dou g by dou squared g by dou s squared minus 1 by s squared. And dou g by dou t. Here we don't have any t, so I'll take it as 0. So now I substitute this back. So the dg for me is coming out to dou g by dou s times mu s. Dou g by dou s is 1 by s times mu s. Okay. Dou g by dou t is 0. Half dou squared g by dou s squared minus 1 by s squared. Sigma squared s squared. Okay, s squared is going up minus sigma squared by 2. Right, so it is coming out, dg is coming out to mu minus sigma squared by 2 dt plus dou g by dou s is 1 by s sigma s ds, which is sigma dz. Now what we are seeing is, if I am taking g as log s, a function, I am taking g as log s, so the dg, which is for the change in the value of g, is also following an Ito process with a mean mu minus sigma squared by 2 as well as the variance being as sigma. It's very important. This derivation is very important in the Black-Scholes results. The same logics I can use for almost anything. For forward contracts, let's say f equal to this. Now I can find out dou f by dou s, dou f by dou s squared, dou f by dou t. Again df. So from here I can very well find out that the change in the forward price is coming out to this kind of an expression. The Ito's lemma, anything that I am taking up, right, because in the Ito's lemma, anything that I am taking up, I just need the function of this form, right? If something is following an Ito process, I can really find out the change in the value of anything else which is dependent on x and t by using this Ito's lemma simply. The simplification becomes more and more comfortable by using the Ito's lemma. And just now we have looked at the dg. If I am saying g is log s, all this we have found out the dg came out to be this much. So dg, which means when I am saying g equal to log s, this is a constant, this is a constant. So the log s is following a generalized Wiener process. And if you simply start looking at that integration of it, right, if you are looking at log s t minus log s0, it follows a normal distribution, right, because delta g, I'll write it as mu minus sigma squared by 2 delta t plus sigma epsilon square root of delta t. So it follows a standard, it follows a normal distribution, log st minus log s0. The change follows a normal distribution with a mean mu minus sigma squared times t, variance sigma squared times t. So log st is also following a normal distribution with log s0 plus something. So a variable has a log normal distribution if its natural logarithm is normally distributed. So I can very well say the stock price, if it is following a log normal distribution, it is having this kind of a property. Log st is following a standard normal distribution with the mean of log s0 plus mu minus sigma squared by 2 times t and a variance of sigma squared t. That is what is basic understanding of the log normal property. So that's what we would like to conclude as a part of this session. We talked about the Markov property, we talked about the continuous time stochastic process, we got into a stock price process, which is a geometric Brownian motion, understood where the mu and sigma come from and what do they represent. If at all I have to use the correlated processes, how can I use Monte Carlo simulation both for uncorrelated as well as correlated process, simplifying the differential equations using the Ito's lemma, and towards the end we came out with the log normal property associated with the stock prices. So these are the things that I wanted to cover as a part of this session. All right, thank you.